Bank of America just published a report that most people will never see, and the ones who do see it are already moving their money. The report is called "The Door to Doom Has Opened." Not a blog post, not a Reddit thread. One of the biggest banks on the planet, managing trillions of dollars, chose those words deliberately and sent that report only to their institutional clients, the hedge funds, the pension managers, the sovereign wealth funds. You were not on the mailing list. The gap between what those people now know and what the average investor believes is exactly where financial disasters are. Made every major crash in modern history followed this same pattern. Institutions saw the warning signs, repositioned quietly, and retail investors found out about the problem when their portfolios were already down 30%. That cycle is setting up again right now, and the only question worth asking is whether you are going to be on the right side of it this time or the wrong side. If what you just heard matters to you, subscribe right now. Because what gets broken down on this channel for free would cost you thousands in private financial consulting. Hard numbers, real frameworks, zero sugarcoat. Hit subscribe, hit the bell, and keep watching, because the next 25 minutes could genuinely change how you think about your money forever. There are two financial worlds running at the same time right now. The first world is the one most people live in. Diversify, be patient, buy and hold, the market always recovers. The second world is where institutional money actually operates, where research reports with titles like "Door to Doom" circulate quietly while cable news talks about market resilience. Bank of America's report belongs entirely to that second world. Peter Lynch, who ran Fidelity's Magellan fund and averaged 29% annual returns for 13 straight years, always argued that individual investors have a real edge over institutions. Speed, flexibility, and no bureaucratic approval process slowing them down. But that edge only works if the individual investor actually has the information. Right now, you have it. So let's go through exactly what Bank of America found and why it matters to your money. Today, the first thing Bank of America identified in their report is what they're calling the Maginot Line. And the historical reference is not accidental. The original Maginot Line was a massive fortification France built after World War I, an enormous defensive wall considered completely impenetrable. The Germans simply went around it. The entire structure failed. Bank of America used that exact term to describe the 30-year U.S. Treasury yield, which is the interest rate the government pays when it borrows money for 30 years, for decades, through crashes, recoveries, wars, recessions, and everything in between. That yield stayed below 5%. That level was the dam. Investors accepted those returns because lending to the U.S. government was considered the safest transaction in the global financial system. When that yield crosses above 5%, the bond market, the largest and most coldly rational market on earth, moving in trillions, not billions, is sending one very specific message. It is saying that the world's smartest money no longer feels comfortable accepting the old terms. It is demanding higher compensation because it senses higher risk. That is not a technical footnote. That is the financial equivalent of the canary dying in the coal mine. Bank of America went back through every major bubble in modern history: Japan in 1989, the NASDAQ in 1999, U.S. housing in 2007, and found the same pattern every single time without exception. When long-term government borrowing costs spiked to this level, the boom ended. The 30-year Treasury yield has now crossed 5%. The dam has cracked. The second alarm bell in the report is something Bank of America calls the 4% inflation rule, and this one is grounded in a century of hard data after studying 100 years of market cycles. Bank of America found that whenever consumer inflation rises above 4%, stocks drop an average of 4% over the following 3 months and an additional 7% over the following 7 months. Right now, consumer prices in the United States are rising at close to 4%. That is the number people see in headlines. The number they are not seeing is that producer prices, what manufacturers pay for raw materials, energy, components, and labor, are rising at 6%. Those costs do not disappear inside the supply chain. They travel through it and eventually land in your grocery bill, your utility statement, your rent, and your car payment. When that happens, purchasing power shrinks. People buy less, corporate revenues contract, and when that contraction begins, the Federal Reserve has no real choice but to raise interest rates, because controlling inflation is their primary mandate. Higher interest rates make borrowing more expensive across the entire economy. For corporations carrying debt, for consumers buying homes, for businesses financing expansion. Every single lever in the economic machine gets harder to pull simultaneously. Bank of America's model is pointing toward 5% inflation. This is not speculation built on feelings. It is a 100-year pattern currently unfolding in real time. The third alarm bell is the one Bank of America calls the alligator jaws. And the visual is important because it makes the mathematics impossible to dismiss. Picture an alligator opening its mouth as wide as it physically can. The top jaw is the stock market, grinding higher on AI enthusiasm and tech concentration. The bottom jaw is the bond market, moving lower as bond prices fall and yields rise. The gap between those two jaws, between stock market performance and bond market performance, is currently the widest it has ever been in recorded financial history. Wider than before the dot-com crash, wider than before 2008, wider than any point in the dataset. And the one thing that is mathematically certain about alligator jaws is that they always close. There are only two ways that closing happens. Either stocks fall down to meet bonds, which is what occurred in 2000, 2008, and 2020, or bonds recover up to meet stocks, which would require inflation to vanish almost overnight and interest rates to collapse back to near zero levels simultaneously. One of those outcomes requires a miracle. The other one requires only history to do what history has always done, and history has a considerably better track record than miracles. There is something that sits beneath all three of those alarm bells, like a fault line under a city, and it does not appear as a labeled section in the Bank of America report. But it is the engine driving the entire situation. It is called the wealth effect, and right now it is operating at a scale that puts everything in context. When stock prices rise, people feel wealthier. When people feel wealthier, they spend more money. When consumer spending increases, corporate revenues go up. When revenues go up, stock prices rise further. The loop feeds itself, and everyone inside it feels like a genius. U.S. household stock market wealth grew by $8 trillion 2 years ago, $9 trillion the year after, $10 trillion last year, and another $4 trillion so far this year. Those are genuinely staggering numbers. The problem is that none of that wealth is real in any permanent sense. It is paper wealth, and it exists only for as long as prices keep moving in one direction. The moment the loop reverses, which every self-reinforcing financial loop in history eventually does, that paper evaporates with a speed that shocks people every single time, even though it has never once been surprising in hindsight. Bank of America identified two specific triggers that will end this particular boom loop: politics and the bond market. Both are currently sending warning signals at the same time, but what makes this cycle uniquely dangerous compared to previous ones is the extreme concentration of the rally inside a tiny number of technology and semiconductor stocks. The top 10 stocks in the S&P 500 have driven 72% of the entire market's gains this year. The other 490 stocks in the index, the vast majority of the companies that make up the benchmark that millions of retirement accounts are tracking, have collectively produced less than 30% of total returns. That means the entire story of a healthy, rising market is being written almost entirely by AI chip makers and a small ring of mega-cap technology companies. Bank of America compared current semiconductor valuations not to the dot-com era, but to the Mississippi bubble of 1,700 seconds, France, where irrational confidence in a single speculative theme drove prices to levels that had no mathematical justification. When that bubble broke, it destroyed an entire generation of wealth. The Japan comparison is more recent and more sobering. In 1989, Japan's stock market carried the same concentration and the same euphoria currently visible in U.S. technology stocks. When it crashed, it fell 80%. It took 30 years to recover. People who were 40 years old when that crash arrived were 70 years old before they even broke. That is not an abstract data point. That is a retirement that never happened. Now, here's the part that does not appear in Bank of America's report, because institutional research is written to warn clients not to hand them a roadmap. Every single major market crash in modern financial history has produced a wave of individual stock returns that made prepared investors extraordinarily wealthy. The mathematics of this are not complicated. When COVID collapsed the market in March 2020, a $10,000 investment in Freeport McMoran returned $98,000 within 24 months. That is a 9.8x return. Royal Caribbean returned 9x. Zoom returned 7x. Block returned 7x. The average return across the major crash winners of 2020 was 5x in under 2 years. Apply that to a series capital base. A $50,000 position spread across a basket of crash winners after March 2020 returned an average of $250,000 in less than 24 months. The 2008 crash produced the same pattern with different names. Royal Caribbean again returned 9x in 22 months. Bank of America itself returned 6x. Freeport McMoran returned 7x. Caterpillar returned 5x. The average winner from 2008 was 5x in approximately 20 months. Every crash, same pattern, different names on the list. The investors who captured those returns were not smarter or luckier than everyone else. They were prepared. They had a watch list ready. They had a framework for identifying which beaten down companies were genuine recovery opportunities versus permanent disasters, and they had the emotional discipline to buy when everyone around them was selling in a panic. The investors who did not capture those returns sold at the bottom, locked in their losses, and watched the recovery happen without them. Those are the only two categories. There is no third option. The reason most people end up in the wrong category has nothing to do with intelligence or access to capital. It has everything to do with the absence of a systematic process that works independently of how you feel on any given day. The framework that consistently identifies crash winners across different market cycles comes down to 4 specific filters applied in sequence. The first filter is deep value recovery, when genuine panic sets in, the kind driven by margin calls, forced selling, and algorithmic cascade liquidations. Good companies get priced like they are going bankrupt. Quality businesses with real assets, positive cash flow, and structural demand behind their products trade at prices that reflect terror, not fundamentals. The specific screen to run is straightforward. Companies that are down 70% or more from their highs, that carry manageable debt levels relative to their operating cash flow, that have positive earnings or a credible near-term path to positive earnings, and that operate in sectors where underlying demand is driven by something structural rather than purely economic sentiment. Freeport-McMoran coming out of 2020 satisfied every one of those conditions. It was priced for bankruptcy and it went on to return nearly 10x. The rubber band principle is real. The more a quality the company gets stretched downward by irrational fear, the more powerful the snapback when rational valuation reasserts itself. But deep value alone is an incomplete filter, because plenty of cheap stocks are cheap because they genuinely deserve to be. Cheap PayPal looked like an extraordinary bargain at 60% below its highs. It then fell another 85% from that point. The value was an illusion, and buying it destroyed capital. The second filter is the secular tailwind, and this is what separates genuine crash winners from value traps. A secular tailwind is a long-duration trend that operates independently of short-term economic conditions. A fundamental shift in technology adoption, demographics, energy infrastructure, or geopolitics that will drive demand in a particular sector for 5 to 10 years, regardless of whether GDP is growing or contracting in any given quarter. The companies that produced 7x and 9x returns coming out of 2020 were not just cheap. They were cheap and sitting directly in the path of an accelerating structural trend. Zoom was not simply a video conferencing tool that became temporarily popular during lockdowns. It was the infrastructure layer of a remote work revolution that COVID compressed from a decade-long gradual adoption into an 18-month forced transformation. Freeport-McMoran was not just a copper miner selling at a discount. It was the raw material supplier for an electrification megacycle, electric vehicles, grid modernization, renewable energy infrastructure that is still accelerating today and will continue accelerating for the foreseeable future. When you combine a company that is genuinely beaten down with a company that sits on top of a genuine secular tailwind, the math changes completely. The stock does not just recover to its old high. The business fundamentals have actually improved during the crash, so the recovery overshoots the previous high on the way to a new one. That is the mathematical difference between a 2x bounce and a 10x transformation. The third filter is what has become known as the too big to fail dynamic. And while there are legitimate policy debates about whether governments should operate this way, those debates are irrelevant to the practical question of where recovery. Capital flows after a crash. Modern governments have demonstrated repeatedly and consistently that they will not allow systemically important industries to collapse because the political and economic cost of true systemic failure exceeds the cost of intervention by any calculation they are willing to make. In 2008, Bank of America, Citigroup, and JP Morgan received government capital and subsequently returned 3x to 6x as the financial system restabilized around the government backstop. In 2020, airlines received government-backed financing and the sector staged a powerful recovery as travel demand returned. The sectors that consistently qualify for this analysis are large financial institutions, critical energy infrastructure, defense contractors, essential transportation networks, critical mineral producers, and major domestic manufacturers. When a company in one of these categories is trading at crash-level prices with a balance sheet too clean enough to survive long enough for the inevitable government support to materialize, The actual risk of permanent capital loss drops substantially below what the market price is implying. The fourth filter is the commodity cycle, and this is the one most retail investors ignore because commodities feel unglamorous compared to technology stories. That preference is expensive, and the historical return data makes the cost of that preference very clear. Every economic recovery, without a single exception in modern history, requires physical raw materials in large quantities: copper for electrical infrastructure, oil for transportation and manufacturing, steel for construction, lithium for batteries, rare earth elements for electronics and defense systems. These materials do not get produced by software releases or AI model updates. They come out of the ground, and the companies that extract them carry enormous operating leverage to commodity price recovery. When commodity prices crash during a financial crisis and then recover as economic activity resumes, the producers of those commodities see their revenues and margins expand explosively because their fixed cost base stays constant while their revenue per unit recovers sharply. Freeport-McMoRan returned 7x out of 2008 and 9x out of 2020 for exactly this reason. Occidental Petroleum returned 6x coming out of 2020. The specific screen here is commodity producers, not traders. Not processors, but actual producers with physical assets in the ground that carry debt levels low enough to survive 2 to 3 years of suppressed prices. Those are the companies that produce explosive returns when the commodity cycle turns. And in the environment Bank of America is describing, the commodity cycle turning is not a remote possibility. It is the natural consequence of the economic sequence they are outlining. There's one final thing that separates investors who actually bank their crash returns from those who give every gain back. And it is not about finding the right stock. It is about knowing when to sell it. Peloton is the cleanest example available. It went from $20 to nearly $200 during the COVID crash recovery, a legitimate 9x return from a company that genuinely checked the deep value and secular tailwind boxes in early 2020. It then returned every single dollar of that gain and is currently trading below $5. The investors who entered at $20 and held all the way through are sitting on a 75% loss, despite being right about the initial opportunity. Every position needs an exit strategy built before the entry is made. A specific price target anchored in fundamental valuation, a trailing stop loss that protects accumulated gains as the stock appreciates, and the absolute discipline to honor both triggers without exception when they are reached. The framework for buying and the framework for selling need to operate with the same emotional detachment. Because the moment you start making exceptions based on how you feel about a stock, you have already begun the process of giving your gains back to the market. Bank of America has used their institutional credibility to publish a report with the word doom in the title. 3 independent alarm bells are flashing simultaneously: the 5% Treasury yield threshold that preceded every major crash. In the dataset, the 100-year inflation pattern pointing toward continued price pressure and the widest divergence between stock and bond market performance ever recorded. The semiconductor concentration in U.S. equities is drawing comparisons to the Mississippi bubble and Japan, 1989. You now have that information, and you have a 4-filter framework for turning the inevitable correction into the most profitable trade of the decade. There are exactly 2 paths forward from this moment. The first path is to do nothing with what you just learned. Close this video, go back to your routine, and hope that this time the warning signs are wrong. When the crash arrives, and the data says it is coming with a certainty that should make every rational person sit up straight. That path ends with panic selling at the bottom and watching the recovery happen from the sidelines. The second path is to start building the watch list today. Identify the deep value candidates. Map out the secular tailwind sectors. Note the 2 big-to-fail names. Screen for the commodity producers with clean balance sheets. Set your entry criteria and your exit rules before the emotion of the moment makes clear thinking impossible. The people who built that watch list before the 2020 crash turned $10,000 into $98,000. The people who built it before 2008 turned disciplined positioning into 5x to 9x returns. The crash does not create the opportunity. The preparation creates the opportunity. The crash just opens the door.